Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Pushkar Mukewar, co-founder and CEO of Drip Capital, to discuss the disruption of the global supply chain and the $3 trillion trade finance gap. Pushkar, it's great to have you with us. Welcome to Trade Talks.
I'm glad to be here.
Global supply chain issues have garnered major attention during the pandemic and have been felt by consumers and businesses alike. What are some of the key issues the ecosystem is still dealing with due to the pandemic?
So I would say that, bunch of issues. Container shortages and freight rates are all-time highs still. There are still supply chain bottlenecks. There's energy crisis in the EU and China power out usage restrictions. Exporters are still operating on minimal margins and maybe even making losses given the high freight rates right now. Inflation is still a huge issue, and weather changes and climate issues are also leading to uncertainty in crop production across multiple geographies.
Specific to the US, what are the biggest challenges facing importers and shipping companies right now?
So I guess the supply is high from all Asian and Latin American countries. However, because of the upcoming holiday season in the US, however, most of the US buyers who we interact with are still sitting on historically low volumes of inventories. Importers, because of obviously the freight costs, are paying high costs and have to pass them on to consumers. There is no reliability still of the entire shipping ecosystem, and there's a lot of uncertainty throughout the supply chains. I guess one of the main problems is just the lesser labor throughout the supply chain, as you know, because of outages, because of obviously like COVID restrictions. There's less workforce to load and unload containers at ports. And because of this, obviously, containers are getting stranded. There was this issue where 60 plus ships were jammed, at the LA port. Even US FMC is now stepped in and is investigating this matter of high freight rates and challenging carriers, which are charging shippers such high exorbitant rates. I guess Congress is also proposing changes to the Shipping Act to spur more competition and protect the US from being taken advantage of by foreign carriers.
Pushkar, how do you think this will impact trading patterns in the near term and long term? Will we see importers looking to other sources abroad or consider more domestic sources?
Definitely. I think the US importers will continue looking to adopt the China plus one strategy, at least in the short term, benefiting countries outside of, broadly within Asia, including India, Thailand, Vietnam, Indonesia. I guess if the situation persists in the long term, US might divert demand to regions nearby. There might be a shift towards more intercontinental, intracontinental trade compared to transcontinental trade. Definitely higher supplies can come from LATAM than across the Pacific from Asian countries, which is what the pattern is today. And, when we look at sort of the US-India corridor, 20% of the invoice value today is freight costs, right? And this high costs is going to drive kind of, changes to trading patterns over time. And I would definitely see that, importers also starting to look at sourcing locally and perhaps even setting up manufacturing plants in the US. So we would see a trend towards regionalization versus globalization.
And Drip Capital claims it's trying to solve the $3 trillion trade finance gap. Can you explain a little bit about why this gap exists and what firms like you and billers are doing to try and address these working capital challenges for small and medium-sized businesses around the world?
Sure. So I think when we think about small and medium-sized businesses in emerging markets and across the world, I think one of the big challenges when they are engaged in cross-border trade is that there's a large sort of payment gap which exists, which means that the shipper ships out the goods. They're still waiting like 60, 90 days to get paid, just given the long transit times. And there's no easy way for the SMBs to fill this gap. Today, they are largely reliant on their local banks, which have high collateral requirements, often bureaucratic processes, which results in many of these SMBs not being able to get adequate or any financing from these banks, right? That's where we come in. We are leveraging technology to offer really a seamless solution for SMBs, where they can basically avail a one-click financing on our platform. So as soon as they ship, they can get paid. And we're doing this by leveraging a lot of technology across the entire kind of trade cycle, leveraging a lot of third-party electronic data to be able to offer this solution to SMBs globally.
And to wrap up here, how can investors take advantage of the growing receivables market?
Great. So I think receivables as an asset class has just been something which we've seen historically has had very low default rates. Even through DRIP, we offer investors an option to invest in our notes program through which they can get exposure to this asset class. Historically, this asset class has been uncorrelated with other traditional asset classes like equities and fixed income instruments. And given the sort of low duration, high yield, and strong performance of this asset class, we do feel like this would be an asset class which investors would find attractive. And as I think many of these emerging platforms, including ours, are encouraging or providing opportunities for investors to participate in this asset class. So, yeah.
All right, Pushkar, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Great. Thanks for having me.